Hello everyone, welcome back to Fundrise Finance. Hope everyone is doing fine. And just like that, we come to the end of February. This year has been crazy so far, with all the volatility sparked by the hawkish tone from the Fed regarding rate increases and the Russia-Ukraine war situation. My sympathies with all the Ukrainian people who are impacted in this war. The only thing we as investors can do is capitalize on the downturn in the stock market and make smart purchases. In this video, I have analyzed 5 dividend stocks which I feel are very undervalued at the moment and offer a good risk reward investment in the long run. Let's check it out. First on our list is Medtronic, ticker symbol MDT, from the healthcare sector. Medtronic is a global manufacturer of medical devices such as insulin pumps and pacemakers. Year to date, Medtronic has given 2.31%. Over the last 1 year, it has fallen over 10%, but for the last 5 years, it has been positive. Overall, it has a dividend yield of 2.44% and a very good P ratio under 20. It has a good payout ratio of 44 and a 5-year growth rate of 8.14, which is above the current inflation of 7.5, and it has been giving a continuous dividend growth for last 8 years. Coming to the financials of the company, the total revenues have been on a good upward trajectory. Also, the gross profit looks good, and also the operating income. When you look at the net income, even that is on an upward trajectory. When you look at the dividends per share, it has been growing year over year on a nice upward trend. Even the free cash flow for the company is on an upward trajectory, which is very good, so that it has enough cash on hand. As per Track Your Dividends website, this stock has a dividend score of 71. So this is again a brief picture of the whole company. So dividend yield is on a very good. The EPS trend only seems to be in a danger mode. And as you can see here, the dividends per share has been constantly increasing, which we want to see. From a valuation perspective, they feel the company is almost 10% undervalued. I consider this calculation to be a bit crude. In my own analysis, which considers the current yield and the trailing 4-year yield, I came to the conclusion that Medtronic was 12% undervalued. The fair price of Medtronic, as per my calculations, was around $119. The second stock on our list is Air Product, from the material sector. The ticker symbol is APD. They provide essential industrial gases and equipment to a variety of industries, and they build, own, and operate some of the world's largest industrial gas projects. Year to date, this company has taken a real beating of minus 21%. The last year it is down 7.68, but over the last 5 years it has given a healthy return of 70.65%. It has a dividend yield of 2.76%, and the PE is 23.2, which is a decent one. Air Products is a dividend aristocrat, so it is part of the S&P and paying consecutive dividends for the last 39 years at a very good 5-year growth rate of 12.63. The payout ratio is slightly higher. Ideally, I would like to see it below 60, so it is just at the border. When you look at the financials, the revenues are on a nice upward trajectory. Also, the gross profit and the operating income. Even the net income is on a good upward trend. Dividends per share is nice. It keeps increasing every year over year. Even the free cash flow is on a good, nice upward trajectory. As per Track Your Dividends, APD has a dividend score of 81. When you look at the dividend scorecard over here, it has a very good rating in all but the EPS trends. And as you can see here, the dividends per share is increasing year over year. Air Products has a ex-dividend date of March 31st. So if you make the stock purchase before March 31st, you would be eligible to get the dividend payment on May 9th. As per Track Your Dividends, APD is 25% undervalued, but as per my own calculations based on the current dividends and the trailing dividends, it comes out to be around 14% undervalued. So the fair price of APD is $274. Third on our list is TROW price, from the financial sector. Ticker symbol is TROW. TROW Price is an investment management firm. Year to date, TROW Price has taken a real beating of 26%. Over the last year, it's minus 8.3, but over the last 5 years, it has a very good 105% return. The yield is a good 3.36% and the P is just 12. T ROW price is also a dividend aristocrat with a constant growth 35 years. And the 5-year growth rate is a very healthy, just below 15%, and even the payout ratio is excellent of 34%. Coming to the financials of the company, the gross profit is on a nice, healthy upward trend. Also, the operating income and the net income. The dividends per share also is increasing year over year. And when you look at the free cash flow, even that is growing on an upward trend year over year. As per track your dividends, T ROW price has a dividend score of 68. Here we see the dividends per share graph, which is increasing on a nice uptrend. And the ex-dividend for T ROW price is March 14th. So you need to make sure the purchase of T ROW price is completed before March 14th, so you can get the dividends paid on March 30th. Track your dividends shows T ROW price undervalued by 37%, but I feel the calculation is very crude. As per my own dividend calculations using the current and trailing yield, T ROW price is undervalued by almost 8%, and the fair price comes out to be around $157. Next on our list is UGI Corporation, ticker symbol UGI, from the utility sector. UGI is a distributor of natural gas, LPG, electricity, and renewable solutions. It has the UGI natural gas and electric utility, as well as AmeriGas, which is the LPG distribution present across the country. It has a 139-year history and spread across 18 years and 3 million customers. Year to date, UGI is down minus 15%, and over the last 1 year it is minus 2.5, and over the last 5 years it is minus 19%. It has a healthy dividend yield of 3.69% and a very good PE of just 13. From a dividend standpoint, being consecutive growth for the last 18 years, the 5-year growth rate is 7.75, which matches the current inflation. The payout ratio is a healthy 50%. From the financial standpoint, all the total revenues, operating income, as well as net income are on the upward trend. Looking at the dividend per share, we see even that is increasing nicely year over year. From a cash flow perspective, the free cash flow is also increasing nicely year over year, which is a good sign. As per track your dividends, UGI has a dividend score of a very healthy 95. From a dividends, all the factors in the report card look very good. The graph for the dividends per share is on an upward trend, and the ex-dividend for UGI is March 14th. So if you make the purchase for the UGI shares before this date, the dividends will be paid on April 1st. From a valuation standpoint, it shows UGI is 32.78% undervalued, but I don't really go by this metric. As per my own dividend yield calculations, UGI is almost 21% undervalued with a fair price of $47. The fifth and final stock on our list is Leggett and Platt, ticker symbol LEG. This is from the consumer discretionary sector. Leggett and Platt designs and produces various engineered components and products that are used in homes and automobiles. As you can see here, it makes bedding products, a few specialized ones, and also the ones which are used in furniture and flooring and textiles. Year to date, Leggett and Platt is down minus 9.35%. Over the last year, minus 13. Over the last 5 years, minus 24.5. It has a good yield of 4.65% and a P ratio of just 13.2. It has a dividend growth of 29 years. So Leggett and Platt was just moved out of the S&P 500 last month. It has an okay 5-year growth rate of 4.3% and a payout ratio under 60. From the financial standpoint, the total revenues, gross profit, operating income, and also the net income are on an upward trend. The dividend per share is also very good. It's increasing year over year. From a cash flow standpoint, even the free cash flow is increasing nicely. As per track your dividends, Leggett and Platt has a dividend score of 90, and all the factors are rated very good. You can see here the graph of dividend per share increasing on an upward trajectory. The ex-dividend date for Leggett and Platt is March 14th. So if you make your purchase before that date, the dividends will be paid on April 15th. As per valuations, Tracker Dividends calculates Leggett and Platt to be undervalued by 34%. But as per my own dividend calculations, I found Leggett and Platt to be undervalued by minus 17% with a fair price of $44. So if I make a portfolio of $1,000 spread across all these five undervalued stocks, I see the dividend yield of 3.29% and the portfolio generating an annual income of $33. So I feel all of these are very undervalued at the moment and investors should capitalize on. Thanks for watching. If you like this video, please click on the like button and subscribe to my channel to keep informed of all such informative videos in the future. I am not a certified finance planner and all my videos are here are for educational and entertainment purposes only. Everyone should do their own due diligence before investing their hard-earned money. See you all in the next video. Till then, let us try as much as we can to be financially healthy. Bye.